Imagine a massive global company just doubling its revenue over a single decade.
It's a staggering thought, really.
Yeah, like they go from making $32 billion a year to a staggering $65 billion a year. Naturally, you would assume they went on an absolute hiring spree to handle all that new business.
Oh, you'd expect tens of thousands of new jobs.
Exactly. But they didn't.
Yeah.
They barely hired anyone at all. I mean, they grew their human workforce by less than 18%.
Wow.
So where did all the tens of thousands of jobs go that should have been created by that kind of massive growth?
Well, it is one of the most profound shifts in the modern economy. And more importantly, it raises the question of how you even spot a corporate machine running that efficiently, or I guess that ruthlessly from the outside.
Welcome to the Deep Dive. Today, we have a mission to demystify a document simply titled Chapter 6, Key Financial Ratios.
Which I know sound...
Oh, I know exactly what you mean. Financial ratios sound like endless spreadsheets and just dull boardroom meetings.
The ultimate cure for insomnia, basically.
Basically, yeah.
Yeah.
But if you stick with us, you are going to see that this is actually the secret language of business. This is the raw detective work you can use to figure out if a company is secretly thriving or, if it is quietly dying behind closed doors.
Yeah, and to understand why this matters to you as a listener, we really should look at how your perspective has to shift as you move up the corporate ladder.
Makes sense.
Because when you are a frontline manager, your world is built on immediate physical reality.
You're tracking things you can touch.
Exactly. You are tracking output per labor hour. Or you're looking at the average length of a production run. Or if you happen to be in the airline industry, you are tracking passenger revenue miles.
Right. Those are statistical indicators that just tell you what happened today. You're in the weeds. You are basically just making sure the machine didn't break down on your shift.
Precisely. But as you progress into senior management, or if you are an investor looking at a company from the outside, you simply cannot look at every single bolt coming off the assembly line.
There's just too much going on.
Way too much. You need a broader systemic overview. You have to translate that physical reality into financial reality.
And the source material breaks that financial reality down into 4 main areas, right?
It does. It breaks it down into liquidity, working capital, profitability, and leverage.
Okay, let's unpack this. If we are looking at a company and trying to figure out if it is actually healthy, where do we even begin?
Well, you start by asking if they can survive tomorrow.
Just tomorrow.
Literally tomorrow. Before any company can worry about like a 10-year global expansion strategy, they have to pay tomorrow's bills. And this is the concept of liquidity.
Okay, that makes sense.
The primary tool we use here is called the current ratio, and it's actually a pretty straightforward calculation.
Well, do it.
You take a company's current assets, which includes cash, the money people owe them, and their inventory, and you divide that by their current liabilities.
Which are the bills and debts they have to pay right now. Wait, so if that calculation comes out to something like 0.9, what does that actually look like on the ground for a business?
It looks like absolute panic.
Really?
Oh, yeah. A ratio below 1.0 means your immediate debts are larger than your immediate assets. Physically, on the ground, it means the CFO is frantically calling vendors to beg for extensions.
Oh, wow.
Or, they are drawing down emergency lines of credit just to make Friday's payroll. It is a severe red flag.
But the text notes something super counterintuitive here. If a 0.9 is terrible, you would think, like, a 5.0 is fantastic.
You would think so.
But the source material says having a massively high current ratio is actually a sign of bad management. Why is having a ton of extra cash or inventory a bad thing?
Because it means you are hoarding resources instead of actually putting them to work. Having that much working capital tied up is just poor asset management.
So it slows you down.
It completely restricts your overall growth. I mean, if you have millions of dollars just sitting in a checking account, or millions of dollars of unsold product collecting dust in a warehouse, that is capital that isn't being used to develop new products or conquer new markets.
Right.
The text mentions that a range of desirability is usually established for this ratio. It's often somewhere around 1.8 to 2.2.
Context seems critical here, too. Like, the source provides a great example about a manufacturer of winter clothing.
Oh, yeah. Seasonality completely warps these numbers.
How so?
Well, a winter clothing company is going to spend all summer manufacturing coats. By October, they have this massive stockpile of finished goods sitting in their warehouse.
Getting ready for winter?
Exactly.
Yeah.
Their inventory is artificially high because they are getting ready to ship everything to retail chains.
And then by January, that physical inventory is gone, but the retail chains haven't fully paid them yet. So their accounts receivable, the money they are owed, just skyrockets.
Right.
The underlying components of their current ratio completely flip in a matter of months, which brings us to a much harsher reality check in the text.
The quick ratio.
Right, the quick ratio or the acid test.
Yeah, so the quick ratio calculates liquidity the exact same way as the current ratio, but it completely strips inventory out of the equation.
I want to make sure I really understand the mechanics of this. To put it in everyday terms for you listening, the current ratio is like looking at the balance of your checking account plus all the random stuff sitting in your garage that you could theoretically sell on eBay if you really needed cash.
I love that analogy.
Thanks. And the quick ratio is just your checking account. It's a much harsher reality check.
That is a highly accurate way to look at it because as the text points out, inventory is not truly liquid.
Right. You can't pay the electric bill with a winter coat.
Exactly. Selling the stuff in your garage takes time, effort, and willing buyers. You might have a warehouse stacked to the ceiling with product, but if consumer trends change overnight and nobody wants to buy it tomorrow,
You're stuck.
You're completely stuck. That inventory will not help you pay the bank tomorrow. So because of that harsher standard, a quick ratio around 0.8 is generally considered acceptable.
We see this exact dynamic play out in the source's case study, which focuses on the Metropolitan Manufacturing Company, or MMC.
Yeah, if we look at MNC's financials, their current ratio was a very healthy 2.23. On paper, they looked incredibly stable.
But then you apply the acid test.
Exactly. When you apply the acid test and remove their physical inventory from the math, their quick ratio plummets to 0.87.
Wow. So they pass the test, but just barely, and it reveals a massive clue about how they operate, right?
It does. MMC is incredibly heavy on inventory. Their cash is entirely trapped in physical goods.
How does a company structurally end up with so much inventory tying up their lifeline? Like, how does that happen?
Well, it usually happens when production is disconnected from actual market demand.
Oh, interesting.
Yeah, they might be overproducing just to keep their factory workers busy. Or they misjudged what the market actually wanted to buy. Whatever the reason, having that much cash tied up in physical goods leaves them highly vulnerable to economic shocks.
So the acid test proves that having assets on paper doesn't mean you actually have cash today. If a company's survival depends on converting those assets to cash, how do they actually force that money through the door?
Well, that requires looking at our second major area, which is working capital management.
Okay.
We have to look at how efficiently they collect the money they are owed and how fast they move that physical product. Let's start with the money they are owed.
The receivables.
Right. The metric here is Days Sales Outstanding, or DSO. It measures the average number of days it takes a company to collect its accounts receivable.
So if your agreed upon credit terms with a customer are 30 days, but your average DSO is 43 days, you are basically acting as a free bank for your customers.
You really are. They have your product, they are generating revenue with it, and you are just sitting around waiting for almost 2 weeks of unpaid time.
That sounds like a nightmare for cash flow.
It is. The text notes that an average collection period in excess of 50 days requires a serious examination of credit risk. And it becomes a cascading problem.
How so?
Because the longer you wait, the less likely you are to ever see that money. The source actually provides an aging of accounts receivable chart for MMC.
Oh, right, I saw that.
They have $36,000 sitting in the above 60 days category.
What usually happens to invoices that get that old?
Honestly, the probability of connecting drops drastically. Companies go out of business, or they dispute the quality of the goods to avoid paying, or
they just ghost you.
Pretty much. They simply realize you aren't going to force the issue. So to combat this, the text offers some fascinating tactical advice for managing receivables.
Yeah, a lot of it is purely operational, like the rule to get the clock ticking.
That's a great one.
Right. Like, don't wait 3 days for your accounting department to mail an invoice. The credit terms should start the exact moment the product hits the customer's loading dock.
Every day counts.
They also suggest training sales teams to encourage the use of plastic, especially on smaller orders. Yes, you pay a credit card processing fee, but accelerating that cash flow is almost always cheaper than the physical expense of printing an invoice, mailing it, tracking it.
And waiting 40 days for a physical check to arrive.
Exactly.
The text also highlights a crucial psychological shift for management, which is never apologize for asking for your money.
Which makes sense. You fulfilled your end of the contract by providing the product.
You did the work.
But I want to push back on the very first tip the source gives. It says credit is a sales tool. and suggests that companies should use credit to motivate buyers.
Uh-huh.
If we want cash in the door fast to survive, isn't extending credit completely counterintuitive? Why would any company voluntarily offer 30-day terms if it just creates these collection nightmares?
What's fascinating here is that extending credit is actually a fundamental competitive advantage. Well, if you demand cash up front, but your competitor is willing to give that exact same customer 30 days to pay, the customer is going to your competitor every single time.
All right.
It allows the customer to sell the product and use that new revenue to pay you. You literally have to offer credit to survive in most industries. The goal isn't to eliminate credit. The goal is to manage the timeline ruthlessly.
That makes total sense.
Yeah.
It's a necessary evil of doing business. And the other necessary evil we mentioned is holding inventory. We measure this with the inventory turnover ratio, which is a company's cost of goods sold divided by their average inventory.
Right.
But why do we even hold inventory if it just traps our cash?
Primarily to avoid losing market share. If a customer wants to buy your product today and your shelves are completely empty, they will buy a substitute from your rival.
Right, you hold inventory to keep customers happy. But the hidden costs of holding that inventory are brutal. It's not just what it costs you to manufacture the item. You are paying for transportation. You are paying property taxes on the warehouse. You are paying insurance.
And you are dealing with physical deterioration.
And seasonal obsolescence. If you are that winter coat manufacturer and you have a warehouse full of parkas in May, those items are functionally worthless for the next 6 months.
Yet you are still paying rent to store them and insurance to protect them.
How do modern companies actually solve this physically? Like, how do they get a high turnover ratio?
Through incredibly tight supply chain logistics. It's often called just-in-time manufacturing.
Oh, I've heard of that.
Yeah, so a high turnover ratio, say 12 times a year, means a company only holds 1 month's worth of inventory on hand at any given moment.
Wow, that is lean.
Very lean. The raw materials arrive exactly when the factory needs them, and the finished product goes straight onto a truck. It frees up all their cash.
Okay, so a company has survived tomorrow by managing their liquidity, and they are keeping their cash flowing by ruthlessly managing receivables and inventory. But eventually we have to look at the scoreboard. Is this company actually making any money?
Which brings us to profitability.
Yes.
The foundational metric here is the gross profit percentage. You calculate this by dividing gross profit by revenue. For our case study, MMC, they maintain a steady 34% gross profit.
And the tech points out this is a considerable achievement for a manufacturing company. It proves they are providing real, tangible value that customers are willing to pay a premium for.
Absolutely.
But the margins vary wildly depending on what you do, right?
Tremendously. If you are a warehouse distributor simply moving boxes from point A to point B, you might only see gross margins of 20 to 25%. You aren't adding much value to the actual product.
Makes sense.
But if you are manufacturing highly specialized computer chips or like patented medical devices, you might enjoy margins of 60 to 70%.
But gross profit only tells us how the product itself performs against the raw cost to make it. If I'm looking at a company, my instinct is to look at the net income the literal bottom line on the income statement.
Sure, that's what everyone looks for first.
Does the company make a profit after everything is paid? But the text specifically warns against this. Why do security analysts and operating managers prefer something called EBITDA over net income?
So EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Quite a mouthful.
It is. But analysts prefer it because operating managers, the people physically running the day-to-day business, do not control corporate financing or taxes.
What do you mean?
Well, the manager of a manufacturing plant doesn't decide if the CEO takes out a massive corporate loan with crushing interest payments.
Right.
And they certainly don't negotiate global tax strategies with the IRS.
So judging a factory manager's performance based on net income is fundamentally unfair to them.
It completely is. EBITDA strips out those executive-level decisions and reveals the pure operating cash flow that the underlying business actually generated.
Here's where it gets really interesting, especially regarding the T in EBITDA, which stands for taxes.
Oh, yes.
The text explicitly points out that the amount of federal income taxes shown on a company's public statement is very rarely the actual amount of cash they paid to the government.
Yeah, the source notes that the tax line is often just a provision.
A provision.
Like a theoretical calculation of, say, 34% multiplied by the net income before tax. But in reality, many companies have highly complex international operations.
Oh, I see where this is going.
Some ostensibly American companies are actually domiciled in what the IRS designates as tax havens.
Meaning they completely avoid the standard U.S. corporate tax rate, yet they might still report a provision for income tax on their public statements to balance the accounting. And to be clear to you listening, we aren't taking any political sides on the ethics of global tax havens. We are strictly looking at the math in the source material.
Just the math.
And the math shows that for a regular investor looking at a public income statement, the tax number printed on the page isn't necessarily the reality of the cash leaving the building.
Which perfectly illustrates why analysts rely on EBITDA. By looking at earnings before taxes, they strip away the distortion of those global tax strategies and see the true operational health of the company.
So let's say a company is highly profitable and the owners want to aggressively expand. They rarely use just their own cash to build new factories, right? They borrow money.
Almost always.
What happens to the math when a company takes on debt?
This introduces financial leverage, which is the ultimate double-edged sword in business.
Leverage.
Leverage acts as a powerful multiplier for both rewards and risks. We measure this tension by looking at two different return ratios: return on assets, or ROA, and return on equity, or ROE.
Can you break down the mechanical difference between those two for the listener?
Yeah, sure. Return on assets measures profitability against the total assets the company utilizes. So everything from their cash reserves to the heavy machinery on the factory floor.
Okay.
Return on equity measures profitability strictly against the owner's original investment.
Got it.
If a company uses bank debt successfully to expand, they are generating more profit without having to put in more of their own money. Therefore, their return on equity improves significantly faster than their return on assets.
But if we look back at our case study, MMC, their net income declined and their ROE dropped from 10% down to 7.8%. On the surface, that looks like a total failure.
Normally, Wall Street would be very concerned. However, the text reveals the mechanics behind that drop.
What are they doing?
MMC is reinvesting a considerable portion of its profits right back into modernizing the business, rather than paying out cash dividends to the owners.
Oh, I see. So that short-term hit to their ROE is actually a highly positive signal.
It is.
It means management is confident in the future, and crucially, they are funding their modernization through their own earnings, rather than taking out dangerous levels of new bank loans.
It is a very conservative, safe strategy. We can verify their safety by looking at their debt-to-equity ratio and their interest coverage.
Right, because debt requires fixed, unforgiving costs. The bank requires its principal and interest payments every single month, regardless of whether you had a good sales month or a terrible one.
Exactly. So MMC's interest coverage, which measures how many times over their EBITDA can pay their required interest expense, is 7.7 times.
Wow.
Yeah, the text notes that an interest coverage of 4 to 5 times is generally acceptable. So at 7.7, MMC has a massive cushion.
But to understand the devastating mechanics of what happens when a market participant isn't safe, the textbook provides the dramatic example of the 2008 to 2009 real estate crash.
This is where we really see leverage act as a multiplier.
Yeah.
Before the crash, the real estate market experienced wild inflation driven almost entirely by extreme financial leverage. Let's look at the math.
Laid it out for us.
People were buying properties with 90% debt financing. If you buy a $100,000 house, you only put $10,000 of your own equity down and you borrow $90,000.
Right. Now, if the property value goes up by just 20%, the house is worth $120,000. That is a 20% return on the asset. But because you only invested $10,000 of your own money, that $20,000 profit represents a staggering 200% return on equity.
Exactly. The rewards were massively distorted by the debt, which drove the whole frenzy of house flipping. But the text calls what happened next the financial equivalent of musical chairs.
So using leverage is like putting nitrous oxide in your car.
Yes.
If you're driving straight and the road is perfectly smooth, you win the race in record time.
Yeah.
Your ROE skyrockets.
But if you hit a tiny bump,
the resulting explosion takes out the entire car.
And in 2008, the bump was the music stopping. When there were no more buyers willing to pay inflated prices, asset values began to drop. But the critical mechanic of debt is that it does not shrink just because the value of your asset shrinks. Individuals and companies still owed massive fixed interest payments, but they could no longer flip the asset to generate the cash.
Which is terrifying.
Those with high debt lost absolutely everything.
It's a stark reminder that debt requires flawless execution. Okay, we have looked at how companies manage cash, how they move inventory, how they calculate true profit by stripping away taxes, and how they balance the explosive risks of debt.
We've covered a lot.
But let's step away from the pure balance sheet for a moment. We need to look at the human element of all this corporate efficiency.
Ah, yes. We are looking at the ultimate efficiency metric. Revenue per employee.
Revenue per employee.
Yeah, it is a single all-encompassing number that captures a company's economies of scale, their improvements in product mix, their investments in automation, and their outsourcing strategies.
Let's go back to that mind-blowing Johnson & Johnson scenario we opened the show with.
Oh.
In 2001, Johnson & Johnson had roughly 101,000 employees, and together they generated $32 billion in annual revenue. That breaks down to about $317,000 of revenue for every single employee.
Fast forward exactly 10 years to 2011, Johnson & Johnson had 118,000 employees, but they generated $65 billion in revenue.
Double the revenue.
Double the revenue. That is $550,000 per employee. They doubled their revenue output while growing their human workforce by less than 18%.
How does that actually impact the wider world?
Yeah.
Like economically?
If we connect this to the bigger picture, the text runs a fascinating macroeconomic thought experiment. What if Johnson & Johnson had not improved their efficiency? To hit that $65 billion revenue mark using their old 2001 efficiency levels, they would have needed over 205,000 employees.
But they only employed 118,000. That leaves a massive gap of roughly 80,000 theoretical jobs that simply never needed to exist.
Now multiply that phenomenon across the thousands of large corporations operating globally.
That's millions of jobs.
Millions. The text argues that the absence of this theoretical job growth isn't due to bad government policies or temporary recessions. It is the direct mathematical result of improved management methods and technological advancement.
Technology allows companies to do infinitely more with significantly less human capital.
Exactly.
Okay, we have covered a massive amount of ground today. The source provides a literal cheat sheet for scanning financials, so let's give you a quick and dirty summary. Here are the 4 absolute essentials you need to remember.
Number 1, the current ratio.
Right. If you see it under 1.0, the company is having immediate liquidity issues and is physically struggling to pay its bills.
Number 2, days sales outstanding.
If it is stretching over 60 days and growing, the company is facing cash flow bottlenecks. They're acting as a free bank and are likely too afraid of losing customers to demand payment.
Number 3, gross profit.
If you see their gross profit percentage steadily declining, even while total revenue goes up, the company is essentially buying its cash flow. They are slashing prices just to get business, or they are pushing inferior products.
And number 4, the debt-to-equity ratio.
If long-term debt divided by equity is less than 1.0, the company has a safe cushion. But if you see a ratio higher than 2.0, a severe cash constraint is imminent, because they are going to have to divert massive amounts of operational funds just to service that debt.
Spot on.
So what does this all mean for you? It means that the next time you look at a company, whether you are interviewing for a job, evaluating a major competitor, or deciding if you want to buy their stock, you don't have to guess.
No, you don't.
You have the actual tools to look past the marketing brochures and see the raw mechanics underneath.
It also leaves us with a highly provocative reality to consider about the future.
What's that?
Well, we just discussed how technology allowed companies like Johnson & Johnson to double their revenue while suppressing human hiring over a decade ago.
Yeah.
But that was achieved primarily through better software, logistics, and outsourcing. What happens to the math of revenue per employee right now as artificial intelligence enters the workforce?
Oh, wow.
If these financial ratios demand constant, unending optimization, what happens to the global economy when the employee part of that equation isn't human at all?
It is a profound shift built right into the math.
Yeah.
Something to think about. Thank you for taking this deep dive with us. The numbers never lie, but they certainly challenge us to look closer.